Emergency funds and sinking funds are terms that you'll commonly come across in the field of personal finance. Both refer to savings that are set aside for a specific purpose. In this case, to cover the expenses you may incur for unexpected events. It's pretty much accepted that they are an absolute must-have for good financial health. In this video, we'll go through what these funds are, why they are important, and how to build one. First off, what are emergency funds? Emergency funds are savings that are set aside to cover unexpected expenses or emergencies. These funds are meant to be used for things like medical bills, car repairs, or urgent home repairs. Emergency funds are typically kept in a separate savings account from other investments or savings, such as for retirement or vacations. The purpose of the separate account is to ensure that the funds are not used for anything other than emergencies. Notice that we mentioned savings account, which will not always give you the highest returns. But this is for a reason. Emergency funds aren't supposed to grow your wealth. Rather, they are intended to be an easily accessible source of cash that you can tap on when catastrophe strikes. For this reason, you shouldn't invest emergency funds into stocks or bonds, since those are not always the easiest or quickest to liquidate. And it goes without saying that real estate is completely out of the question. Later on in this video, we'll go through a couple of alternate places you can consider putting your emergency fund, apart from a plain vanilla savings or checking account. Why do you need an emergency fund? As we talked about earlier, life is unpredictable, and it's impossible to know when an emergency will strike. Emergencies can be anything from a sudden job loss to a medical emergency, to the upkeep of your vehicle, or a large home expense. Having an emergency fund in place can help alleviate the stress and financial pressure that comes with unexpected expenses. It can be the difference between having to take on debt, or being able to handle the unexpected without any financial strain. You may think that a credit card is a good option to cover emergencies, since there is a ready line of credit that you can tap into to cover those expenses. But unless you have the means to pay your card balance off in full, this is a bad idea, as it will send you into debt. And not just any kind of debt either, but the worst, most expensive kind, as credit card interest can easily top 15 or 20%, depending on where you live in the world. So while it seems like a credit card is the most convenient option, it's probably the worst way to cover an emergency. Nothing beats having the actual cash stashed away. How much should you have in your emergency fund? The size of your emergency fund depends on your individual circumstances. However, it's commonly accepted that having at least 3 to 6 months of living expenses saved up is a best practice in case of emergencies. This includes expenses such as rent or mortgage payments, utilities, groceries, and other essential expenses. If you have dependents, you may want to consider saving even more, as there may be other important expenses such as school fees or prescription medicine. It's important to consider only your must-have expenses when calculating how much you need, as you really don't want to be dipping into your emergency fund to cover luxuries, like eating out or buying electronics or gadgets. At the same time, you don't want to be putting away too much either, as this will probably mean that you're not making your money work hard enough for you. So if you're able to put away 6 months worth of expenses for a rainy day, you've done pretty well. So how do you build an emergency fund? Building an emergency fund isn't something that happens overnight. It does take a bit of time and planning. Here are some steps you can take to build your own emergency fund. Number 1. Set a dollar amount goal. The first step in building an emergency fund is to set a target. If money is really tight and you're not able to put that much away every month, you can start by determining how much money you need to cover your essential expenses for 3 months at first. Conversely, if you can afford to set a bit more aside every month, you can think about shooting for 6 months' worth instead. Either way, it's important to have a figure to aim for, so that it becomes tangible. It will also be much easier to track progress. Number 2. Create a budget. Creating a budget is an essential building block in setting up an emergency fund. We've talked about this in many other videos as well, but in summary, By creating a budget, you can see where your money is going and identify areas where you can cut back. This will help you free up money to put towards your emergency fund. Be sure to set aside a portion of your income each month specifically for your emergency fund. Even a small amount put away regularly will add up over time, and a budget will tell you how to find these amounts. Of course, earning more will make it easier to achieve your saving goal. If possible, consider starting a side hustle to increase your income. This has the added benefit of reducing your reliance on your day job for income. There are a wealth of options here, and check out a link in the description if you'd like to find out more. Number 3. Make saving automatic. Setting up automatic transfers from your checking account to your emergency fund savings account can help ensure that you save consistently. You can set up automatic transfers to occur on a schedule that works for you, such as on a particular day every month. This will help you stay on track with your savings goals. To make this even more effective, consider setting up this transfer on the same day or next day as your payday. This will ensure that your emergency fund is given priority. This is sometimes called paying yourself first, and it's a great way to achieve your saving goals. Number 4. Look for ways to cut back. Once you've created a budget, you can look for ways to save money each month. This can include things like canceling unnecessary subscriptions, cooking at home instead of eating out, or finding ways to save on your utility bills. The best thing to do is to go through your budget, line by line, to look at your expenses. Then seriously question whether you really need each one. If you don't, that's a cost that can be removed. Even if the expense is a must-have, think about whether you can find a lower-cost option. For example, you can look for cheaper mobile or broadband plans, which can deliver some significant savings. Remember, each dollar you save is a dollar that can be put towards your emergency fund. Number 5. Consider options other than savings or current accounts. While it's important to keep your emergency fund separate from your other savings, you should also try to make sure it delivers some kind of decent return so that it isn't completely idle. Keeping it under your mattress or buried in your garden is definitely not the right thing to do. If you place your emergency fund in a regulated bank, it's most likely to be insured, making it a very safe option. This is unless your emergency fund is so huge that it exceeds the insured limit. While safe, banks also have some alternative options to give you more bang for your buck. For example, high-yield savings accounts typically offer higher interest rates than traditional savings accounts. This means that your emergency fund will grow faster, and you'll earn more money in interest over time. Try to avoid a high-yield account with monthly service fees though, as these will eat into your fund and reduce the interest that you earn. Another option that you may have, depending on where you live in the world and what your bank offers, are offset mortgages. Sometimes called flexi mortgages, these are typically savings accounts that are linked to your mortgage loan account. The loan balance gets reduced by the amount in your savings account, and you can save on the interest or the repayment. This means that you either end up paying less each month, or your principal will get paid off faster. This is an attractive option for emergency funds, especially if you have a big mortgage or a high interest rate. For both these options though, it's important to ensure that the savings account comes with an ATM or a debit card, so that you have easy access to your cash. Check out these videos next, on the best ways to save more money.